Hi, welcome to SCCA F5 Performance Management. Once again, I'm called cont'd, and today we shall be looking at pricing, which is one of the key topics and decision-making part of the syllabus. As usual, you can reach me on john.cont'd@gmail.com. To start off, let us look at the scope of our discussion today. One, we shall briefly look at what determines the price of a product. Then we shall look at a concept called price elasticity of demand. Then we shall evaluate the demand function and try to theoretically find a profit maximizing price. Eventually, we shall look at the different pricing strategies a firm might use for its products or services. So let's briefly look at what determines the price of a product. Now, of course, we have demand. Economic theory suggests that the higher the price of the product, the lower the quantity demanded. So we shall look at this in detail when we look at the demand curve and how to determine the equation. And of course, there are many other factors which will affect the demand of a product. Then costs. The price you set should be able to recover the cost. So it's usually the cost plus a certain margin. So definitely the cost will affect the price of the eventual product. The competition directly affects the demand. If you have many parties competing for the same customer base, then you're likely to see a fall in the price. Whereas if you have a monopoly kind of situation, then the price will likely be high. Then quality. Usually quality, the higher the quality, the higher the price of a certain product, and vice versa. Inflation will directly affect the costs which you're going to charge to your product, and definitely will affect the price which you recover from your customers. The newness of a product. Most times when a product is new to the market, it will have an initial high price which will eventually come down with time as competition creeps into the market. So briefly, these are some of the factors. This list is in no way a complete list of issues which affect the price of a product, but it's just an indication of some of the key issues which your examiner expects you to have a clear idea about. So we shall look at the concept of price elasticity of demand. The definition is simply right here. So elasticity of demand is the percentage change in quantity demanded divided by the percentage change in price. Why is this important? For F5, because one, we need to know the elasticity of our product, because it will eventually affect how we choose to price the product. When the elasticity is greater than 1, the demand is referred to as being elastic. So this means that a small change in price produces a large change in quantity demanded, and this is typical for luxurious items. So the implication for a manager is that increases in price will bring decreases in revenue, because the quantity demanded will change. So you have to be careful when you're pricing for elastic products, because the demand is very sensitive to price. On the other hand, we have elasticity being less than 1. The condition is referred to as inelastic. In this case, prices should generally be increased because the demand is not as sensitive to price compared to an elastic product. This is typical for essential products, okay, things like sugar, fuel, the demand is generally said to be inelastic. Then you have a condition, okay, when the elasticity is equal to 0. This is referred to as being perfectly inelastic. Okay, so what this means is that there is no change in quantity demanded regardless of the change in price. Of course, this doesn't exist in life, in the real world, but if such a product did exist, then it would mean that as a company would charge any price, okay, and still there will be no change in the quantity. So to maximize your profit, you just charge as high a price as possible. Then there is a condition when the elasticity, okay, is infinity. This is referred to as perfectly elastic. The implication here is that customers will want to buy an infinite amount, but only up to a particular level. Okay, so a slight increase for perfectly elastic product, a slight increase in price, okay, will return the demand to 0. So customers can buy as much as possible, but only up to a certain point of price. So graphically, we can represent the perfectly inelastic demand, simply a vertical line, okay. So you can see that whatever the price, okay, there is no change in quantity demanded. Then the perfectly elastic demand, okay, will be a horizontal line, as you can see here, okay. So any price beyond P will return the demand to 0. So that's briefly what elasticity of demand is and why it's important for pricing decisions. So briefly, let's look at the demand equation and profit maximizing price. Now a typical demand curve will look like that, okay. So the higher the price charged, okay, the lower the demand. So this is a typical demand curve. Of course, in real life, this curve wouldn't be this straight. So the demand equation is given as P is equal to A minus BQ, where A is the price at which no quantity is demanded, B is the change in price, okay, over change in quantity, Q represents the quantity demanded, and P is the price. Now you don't have to memorize this. If you're sitting for your SCCA paper F5, this equation will be given as part of the exam formulae. Now to maximize the profit, economic theory suggests that profit will be maximized when the marginal revenue, okay, is equal to what they call the marginal cost. Now again, marginal revenue is given by the following expression. So once again, you don't need to memorize this. This is given in the exam. Marginal revenue is equal to A minus 2BQ. A is still the price at which no quantity is demanded. B is still the change in price over change in quantity, and Q still represents the quantity demanded. Marginal cost represents the variable costs of production, okay, basically the additional cost to make one additional unit of the product. So to maximize profit, the key assumption according to economic theory is that marginal revenue should equal to marginal cost. So let us briefly look at a simple example of how to find the demand equation, okay, and the profit maximizing price. Okay, let's say we're given this information that you have a product when the price is 12, okay, the quantity demanded is 30, and when the price goes up to 15, the quantity demanded goes to 45. That's information given. Then we've also been told that the variable costs are 8, and the requirement is to derive the demand equation and the profit maximizing price. So quickly running through the solution. Now the demand function is given by A minus BQ. So what we need is to find this A and to find this B. Okay, so B we know is the change in price over change in quantity. Okay, so if we look at the information given above, the change in price will be 12 minus 15 divided by 60 minus 45 to give you 0.2. Please, at this point, just ignore the negative sign. Don't include the sign because we've already catered for it, okay, in the demand equation. So ignore the sign, the negative sign. So B is 0.2. So our challenge is now to find A. So we substitute, okay, in price point using price point 1, data for price point 1. Okay. So we shall have the following expression. So 12 will be A. So you can see I've substituted the 60, which I'm getting from here. And if I solve the simple equation, I get A is equal to 24. So which gives me the demand equation as being 24, okay, minus 0.2 Q. So that's our demand equation. To find the profit maximizing price, okay, I told you marginal revenue is A minus 2BQ, and we're equating this to the marginal cost, which is 8. Now if I solve the simple equation, I get Q is equal to 40. If I substitute, okay, in this equation here, okay, you can see that P will be 24, okay, minus 0.2 times 40. This 40 is the figure I'm getting from here, and I end up with a price of 16. So clearly 16 is the price at which profit is maximized. So this is a very simple example which illustrates the concept. In your exam it will be a bit more complicated than this, but the basic principle will remain the same. We shall look at a more detailed exam scenario in a follow-up tutorial. So now let's look at the pricing strategies. Now F5 is about 50% theory and about 50% calculation, so you must have a good grasp of the written bits, and many students don't like the written bits, they prefer calculation, but trust me, it's very important to know the written bits. So you need to do a lot of reading and a lot of research. So the first one is called market scheming. So the basic principle is that you charge high prices when a product is first launched. The key success factor is that, one, the product must be unique so that you can charge a high product. Obviously people are not going to buy and pay expensively for a product which is not unique. Then usually the product must have a short life cycle, so you want to recover much of your costs in the first stages of the life cycle. Then it usually applies when the product or the company has a monopoly position in the market, so it can determine the price. So, and then the product must be of sufficient quality as to warrant high price. So that's the basic principle of market scheming. So it will mainly apply to technological products or very innovative products. Two, on the other side of the spectrum, we have something called market penetration. So the idea is now to charge low prices with the hope of building and market share. Now this only works if one, the product is elastic. You remember, when a product is elastic, the quantity demanded response is very sensitive to the price, to the change in price. So if you lower the price, that means the quantity demanded should go up by a much higher proportion. Then there should be economies for scale. Remember, what we're trying to do is to build market share. By building market share, we hope that the unit cost of production will be down and we shall be able to make a profit. So there should be economies of scale from building volumes. Then it may be used as a strategy to discourage new entrants. So if you charge very low prices, the market may be unattractive for new competition. So in an exam, this information will be given within the scenario. Okay, so they will indicate that one, the product is a technological product. It is about to be launched. Okay, it is a high quality, unique product. So, and then they will tell you to suggest the pricing strategy. Of course, if you suggest market penetration, then the examiner will know that you don't know what you're talking about. Such a product, the best strategy would be market skimming. So briefly, let's look at other strategies. There's something called full cost pricing. Okay, so basically you just add a markup to the full cost of production. Then there's something called marginal cost plus. Here the markup or margin, okay, is added to the marginal cost. And remember, marginal cost is the variable cost. The advantage with these two is that they're very easy to understand and very easy to apply. The main disadvantage is that they don't take into consideration the market conditions, the demand. So they ignore the external components which affect the price. So you end up charging based on a cost, but the customer may not be willing to pay for that cost. Or you could have charged a higher price to optimize your profit. So these two are not really supported by economic theory, but they're very practical things, and usually many companies actually prefer to use these. There's something called complementary product pricing. A complementary product or complementary products are products which are used in combination. A simple example would be, for instance, a toothbrush and toothpaste. So this could be considered as complementary products. So the idea is that if you're marketing these two, is that you charge different prices for each. For instance, you may give out a free toothbrush, okay, but then charge a high price, okay, for the toothpaste. Okay, so the idea is to charge different prices for the different complementary products, okay, so that you're able to sell the complete set. Okay, so those are complementary products. There's something called price discrimination. Basically, you're pricing according to different demographics. Now, this could be based on gender, okay, it could be based on geographical location, it could be based on age, it could be based on income, it could be based on race. So the basic idea is that you find different price segments and create the product, okay, to meet those different segments. So that's basically price discrimination. Then finally, there's something called relevant cost pricing. We shall have a more detailed lecture to discuss the relevant cost pricing principles. But for now, a relevant cost is the future incremental cash flow. So if, for instance, you're bidding for a job, the minimum price you should charge should be the relevant cost to undertake that job. So we can determine a relevant cost for material, a relevant cost for labor, and for other costs. So relevant cost pricing considers future incremental cash flows arising out of the decision you've undertaken. And then finally, a quick recap. We've looked at the determinants of a price. We looked at demand. We looked at the cost. Okay, we looked at competition and other factors which determine the price of a product. We defined elasticity as the percentage change in demand divided by the percentage change in quantity. We saw that we can have demand which is elastic, meaning that demand is very sensitive to changes in price, and demand can also be inelastic, meaning the quantity demanded doesn't change much given a change in price. We finally looked at the demand equation, P is equal to A minus BQ, and we established that the profit maximizing price occurs when marginal revenue is equal to marginal cost, the marginal revenue being represented by A minus 2BQ, and the marginal cost representing the variable cost of production. Then finally, we looked at different pricing strategies. We looked at market scheming, where you charge a higher price. We looked at market penetration, where you charge a low price to build market share. We looked at full cost plus pricing, where a markup is applied to the full cost. We looked at the marginal cost plus pricing, where a margin is applied to the variable cost of production. We looked at complementary product pricing. We looked at price discrimination, where you price according to different demographics. And finally, we looked at relevant cost pricing, where relevant cost was defined as a future incremental cash flow. Okay, thank you guys. I hope this has been useful. Please provide some feedback. But all the same, I wish you good luck in your exams. Thank you.